So, good day everyone. My name is Cheers Grizzly Tietes. This is the continuation of our report in Chapter 7, which is Making Market Work, the Critical Rule of Market Infrastructure. Contract standardization. Derivatives exchanges create standardized contracts for trading on the respective exchanges. In contrast to the OTC derivatives market, market participants have no ability to alter the terms of the exchange-traded derivative contracts. Derivatives exchanges also typically attempt to minimize the number of contracts related to specific underlying and risk exposure type. The standardization of contracts, as well as a finite number of contracts in a given underlying, helps to boost liquidity in any given contract, since market participants seeking to buy or sell that particular exposure must trade in one of a few specific contracts. So, in contract standardization is important para sa smooth functioning in derivatives market. It creates a level playing field for all participants, promote transparency, and reduces risk. So, in return, facilitates efficient trading and price discovery. So, by that, mahimong mas attractive sa investor and businesses ang market derivatives. Open interest. Exchange-traded derivative transactions are not trades involving the exchange of a physical asset in the classical sense, as is the case with securities transactions. Rather, an exchange-traded derivative transaction either creates a new exposure or offsets an existing one. Hence, when a market participants buy or sells a derivative contract, there is only one of three possible outcomes. First is a long exposure is created when buying. Second is a short exposure is created when selling. And third, a long or short exposure is reduced by selling or buying respectively. So in open interest, it is a vital tool for market participants including traders, investors, and regulators. So makatabang ni sa ila to understand about market dynamics, as is liquidity and market-informed trading decisions. Open interest is the total amount of long exposure across all participants in the derivatives exchange and can be thought of as the number of contracts created by the exchange net of any contracts that have been closed out or that have been delivered. So by analyzing open interest alongside other indicators like price and volume, so ang market participants makagain of more comprehensive understanding about market sentiment and potential trends. Central clearing of exchange-traded derivatives are almost universally centrally cleared, most frequently through a CCP. In most cases, the clearinghouse or CCP is directly owned by the same conglomerate that owns the derivatives exchange. Prominent examples include CME Clearing, which clears for each of CME Group's four derivatives exchanges, and ICE Clear US, which clears for ICE's US futures markets. There are some notable exceptions to this vertically integrated exchange or clearinghouse model. So in central clearing of exchange-traded derivatives, it plays a vital role in ensuring the stability and efficiency of the market. By mitigating counterparty risk, improving liquidity, and enhancing transparency, central clearing helps to create a safer and more robust environment for trading derivatives. Trading platforms for OTC derivatives contracts were historically exempt from regulation and traded over the counter on a bilateral basis between counterparties rather than on regulated exchanges. Derivative dealers would create derivative contracts on behalf of their end user clients, as well as create contracts with other dealers to hedge residual risk or to take on a risk position. Contract terms could be negotiated and customized based on the needs of the end user client or risk being hedged. Much of this business was conducted by voice over telecommunications networks with limited transparency into the market, in a stark contrast to markets traded on regulated exchanges. So in trading platforms for OTC derivatives, ga-provide sila more efficient and transparent way to trade OTC derivatives for reducing risk and improving market liquidity. As the OTC derivatives, ang market gapadayon og evolve, so these platforms are likely to play an even greater role in facilitating trading and managing risk. European Union Organized Trading Facilities or OTFS. The European equivalent of a swap execution facility or SEF is called an Organized Trading Facility or OTF, which is a new type of permitted trading system introduced under MIFID II, in addition to multilateral trading facilities or MTFs and regulated markets. There is still work to be done to harmonize the EU and US regimes for OTC derivatives trade execution, as these two competing regimes do not perfectly overlap conceptually. Some notable differences include the fact that OTFs can be designed to trade products other than swaps, including equities, commodities, and non-swap derivatives, among other differences. So in European Union, organized trading facilities are regulated platforms designed for trading non-equity financial instruments like bonds, derivatives, and structured products. They operate within the framework of MIFID II, Markets in Financial Instrument Derivatives II, aiming to increase transparency, fairness, and efficiency in the trading of this instrument. Japan Electronic Trading Platforms. In Japan, the equivalent term for an SEF or OTF is Electronic Trading Platform or ATP. Mandatory trading on ATPs was slated to begin in September 2015 for GPY vanilla interest rate swaps. ATPs are conceptually similar to SEFs or OTF. Again, the some subtle but specific differences. ETPs must have an order book or RFQ functionality with no fewer than 3 counterparties. Voice is still an acceptable protocol despite the fact that these are dubbed electronic platforms. So in Japan, electronic trading platforms has made a significant strides in adopting ETPs for derivatives driven by regulatory changes and an increasing demand for efficiency and transparency in the market. Clearing and settlement of derivatives. Derivative contracts are created either by an exchange or through bilateral agreement and must be risk managed through their life until they mature. Counterparty risk between buyers and sellers of derivatives therefore remains open throughout the life of the derivatives contract. The primary way risk is managed is through the upfront transfer of cash or collateral, which in ETD markets is called initial margin and in OTC market called the independent amount, and through periodic margin payments called variation margin, which are typically made in cash. Some select products such as options may involve the upfront payment of cash from the buyer to the seller. Collectively, these cash and collateral transfers throughout the life of the derivative contract can be thought of as the settlement process. So in clearing and settlement of derivatives, it play a vital role in ensuring the efficient and safe execution of derivative transactions by mitigating counterparty risk, promoting market transparency, and enhancing market stability. These processes contribute to a more robust and reliable derivatives market. ETD clearinghouses. In the case where an institution is a member of the derivatives exchange but not of the ETD clearinghouse, the institution must access the clearinghouse through an intermediary called a general clearing member. A general clearing member is a financial intermediary that provides clearing services both for its own account and for clients, as opposed to a clearing member which may only provide these services on its own account. In some cases, a client may have an execution broker that is different from the general clearing member that is acting on their behalf to clear trades at the clearinghouse. So in ETD clearing houses, they provide a critical layers of risk management, ensuring the stability and efficiency of the market. There are several key functions that a derivative CCP must perform, with the most critical ones being: first is registration and novation of the transaction. Once a derivatives trade is submitted to the derivatives clearinghouse, if it is acting as a CCP, the clearinghouse will insert itself between the buyer and seller through a process known as novation. Second is collection of initial margin. At the onset of the trade, the CCP will ask for a deposit on open positions called initial margin or IM, which can be in the form of CCP, eligible securities, and cash. And last is periodic collection of variation margin. Over the life of the contract, the CCP will collect periodic variation margin or VM payments based on the profit or loss on open positions. VM is typically calculated at least daily and is usually settled in cash. So in registration and novation of the transaction, registration in the derivatives market refers to the process by which market participants such as dealers and major participants formally register with relevant regulatory bodies, while novation in the context of derivatives transactions is the process of replacing an existing contract with a new one, substituting one party for another. Then the collection of initial market is not a one-time event. Ongoing monitoring is vital to ensure that margin levels remain adequate to cover potential losses. Then last is the periodic collection of variation margin contributes significantly to market stability by reducing the likelihood of defaults and mitigating the cascading effects of a single counterparty failure.